So it's another great time we meet for this session of advanced financial reporting and analysis. So for today, we are going to talk about no. Who is this unmuted? Anyway, let's continue. So I was saying that we are going to talk about the reconstruction and reorganization of capital structure. So reconstruction and reorganization. Reconstruction and reorganization of a capital structure. Reconstruction, reorganization of the capital structure. So these are scenarios whereby you find that a company is on financial distress. So a company is suffering financially. So what can be done if a company is suffering financially? So a company is not making profits, a company is making losses. So as a director of an entity, what can you advise the entity to do? So what is supposed to be done is just a reconstruction of the entity. So we can go for an internal reconstruction or an external. So reconstruction is all about we alter the capital structure of the entity. So remember that an organization is made up of the providers of capital, who are preference shareholders and ordinary shareholders. And we have the providers of loan, the debenture holders. So a company is made up of ordinary shareholders, preference shareholders, and loan note providers to the entity. So what is supposed to be done now to these providers of capital and loan providers? So if an entity opts for an internal reconstruction, the capital structure of an entity is altered internally without the entity losing its legal identity. So, for example, if it was Edwin Ochoi Limited, it will remain to be Edwin Ochoi Limited. It will not change. The only thing which will change is the capital structure of that entity. For example, the way the loan providers were supposed to be paid will be restructured. It will be changed. The way providers of capital were supposed to be given dividends, the entity will agree with them that instead we pay you dividends from the preference shares you own, we can decide to give you common shares, because the preference shares, they have a preferential right that they have to be paid even in the next year, if this year they make a loss. So it's all about proposals which are done in an organization on how an entity can be driven out of losses so that it starts making profits. So in internal reconstruction, the entity doesn't lose its legal identity. It will remain to be the same entity, but what is altered is the capital structure of that entity. So there's a process which will be followed when we are doing a question. So there's a process which will be followed when altering the capital structure, whereby you will be given a question whereby a company was suffering, then the directors of an entity proposed that this and this be done. So now, how will you incorporate the proposals in that question of yours? How will you incorporate that proposals so that you make sure the statements you will produce at the end, they are statements which generate a positive bottom line. That is a profit. We look at the notes. This is just an overview I'm giving. That is what is required of you. Then, when we talk about an external reconstruction, now here, the entity loses its legal identity. So if it was Edwin Ochoi Limited, it changes. So which means that a new entity is formed to take over the operations of the old company. So another company, for example, now, a different company, but a different name, will be formed to take over the operations of the old company. So meaning the old entity will lose its legal identity to the new entity. And that one implies that the providers of capital in the old company must be compensated. How will this be done? This one will be shown in a question. So For more of your understanding, the notes you have them. But again, I want to go through because it's like a one page. So I will start from internal reconstruction, not even internal reconstruction. I will start from the introduction. That is what we have even done. Then we will move to internal reconstruction. We check what is required, what I've given an overview. We do around 3 questions. Then next will be external. So let's look at some of the notes which are here, which you have. So reconstruction and reorganization of the capital structure. Reconstruction is an alteration of the company's capital structure. A receiver will be appointed. So here now, these notes, they are just talking about internal. So, but you know that reconstruction generally is all about the alteration of the capital structure. So when we talk about internal reconstruction, that is where we appoint a receiver who does the work of altering the capital structure internally. That is whereby he advises the entity on how to operate for the foreseeable future. So during reconstruction, the par values of the ordinary shares are to be reduced. All the preference shares and the debentures are to be exchanged with the new class of preference shares and the debentures. The alteration of the capital structure is adjusted for in a special account known as capital reduction account. So there's that special account, which will come clear once I do a question, is that main account, which we maintain when doing this work of reconstruction. When doing this work of internal reconstruction, that is, when doing this work of internal reconstruction. So I was admitting someone there. So types of reconstruction, I've said this internal and external. So this is the rearrangement. Internal, I have said, is just the rearrangement of the capital structure internally without necessarily selling off the assets and other resources of the entity. So the entity remains to be the same entity. I was using the example of a company by my name. So it remains to be Edinochoy Limited. So under internal reconstruction, the entity will retain its legal identity. So capital reduction account is normally used by the receiver during internal reconstruction, during the internal reconstruction. So I don't want to start with this question of 2014, but I want to start with a question of 2018. So let's look at the question of 2018. We do internal reconstruction. So as we are going to do this question of May 2018, so before we go to that question, so the first thing you always do in any internal reconstruction question, not even anything you do. Some students previous were saying that they don't know how to identify an internal reconstruction question and an external. So an internal reconstruction question, I have explained what it pertains. The entity remains to be the same. The only thing which is altered is the capital structure. External, a new company is formed to take over the operations of the when you see a new company formed to take over the operations of the old entity, then you are told how the old entity is compensated. The providers of capital in that old entity, how they are compensated. That is an external. Yes. So under internal reconstruction, the first thing you always do is the determination of the you do the journal entries, not even the determination of the journal entries. You present or you have to do the journal entries for you to record the narrations or the proposals which have been done by the directors. So you will be told that, for example, this is how they paid dividends instead of the initial way they were supposed to pay. This is how the liabilities were settled. So those are the things you record in the journal entries, meaning that the new narrations, the new proposals are the ones which are recorded in the journal entries. So that is where you start. That is the point where you start. So after doing that journal entries, the proposals which you have recorded in the journal entries are the one now to be taken to the capital reduction. So capital reduction now will be the main account under internal reconstruction. This is our main account under internal reconstruction. So it's prepared beside ordinary share capital. Mostly you will find that once we prepare capital reduction account, you have to prepare ordinary share capital account. Another thing you need to understand, do you know what is debited, what's credited, what's... So, for example, we have an asset account. Remember that under reconstruction, there's nothing they are testing you. It's a double entry concept. Let's say we have an asset account. We have a liability account. But I will not be using the account. I'm trying to create an understanding in your mind. Because on my case, I will record them direct, knowing that I will bring the meaning clear when recording. So the balance brought down of this account starts at which side? Debit or credit?
Debit side. Debit side.
So meaning that an increase of this account is on the debit, decrease is here. So the vice versa for this, increase, decrease. So increase for expense is on the debit side, decrease is on the credit side. Increase is on the credit side, decrease is on the debit side. So the first thing you need to understand before even I do anything, so May 2018, so this is the relevant sitting. That is question 2B. So they are saying the following statement of financial position relates to affairs of Fanakawa Limited as at 31st December 2017. So we have non-current assets, that is land and buildings, plant and machinery. We have intangible assets, goodwill, development expenditure, current assets, inventory receivables, total assets, equity, ordinary share capital, share premium, accumulated losses, shareholders fund, current liabilities, trade payable, bank overdraft, bank loan. Additional information, Fanakawa Limited has been making losses. Emma Fanakawa is this company. So Fanakawa Limited has been making losses in the recent years, but recent board changes and the development of a new product line are believed to have significantly improved the company's future prospects. So meaning that the recent board changes and development of a new product line are believed to have significantly improved the company's future prospects. So we expect good returns in the future. So due to the recent board changes and the introduction of a new product. So the following scheme of financial reorganization has been prepared for consideration by the shareholders and creditors. So this is what has been done. The following scheme of financial reorganization. Who has done this? Who has done this scheme of financial reorganization? It is a proposal by the shareholders and the creditors. Remember that they have interest to the entity. So number one, existing ordinary shares are to be written down to 4 per share and then consolidated into shares of 10 per. So if you check in the statement under the ordinary share capital, our shares were stated at what? So the par value of the share is 10. The par value of the share is 10. Now they're reducing that one from 10 to 4. So the first thing you have to do is to eliminate the par value of 10, and we state our ordinary shares. So the shares now we will be giving out. The shares which we will be giving out. The shares which we will be giving out at 4 instead of what? 10. That is what they said in additional information number 1. Even if later now they would consolidate again to 10. But the first thing you need to understand is that the par value must be reduced. the par value must be reduced. So it has been reduced from 10 to 4. So now you have to eliminate that 10, the shares which are stated at 10, so that you state them at 4. So you cannot be selling shares at 10. There is nobody who is buying. It's better you reduce the par value. You attract more investors. We get funds to finance the entity. Number 2, the existing shareholders are to subscribe to a rights issue of 3 new shares for every 1 share held. After making the changes in one above, the shares are to be issued at 11 each. So existing shareholders are to subscribe to a rights issue. So who can tell us what's a rights issue? What's a rights issue? Someone. And one student can explain to other students what's a rights issue. You know, I know you have done advanced financial management or financial management, so you know what a rights issue is.
Issue of shares to existing shareholders.
At what price, or there's something you have not mentioned, because issue of shares, I can issue shares today as a company. So an IPO can be done, that is issue of shares. A bonus issue can be done, that is issue of shares. Shareholders can purchase shares normally, that is issue of shares. So what's a rights issue, to be more specific?
To existing shareholders.
Yeah,
Existing shareholders.
Existing shareholders
At a reduced price.
at the reduced price. So we always say that the rights issue is all about when you find that a company is giving out shares to the existing shareholders at a price that is lower than the market value. So if the market value of the share was 12, the company gives shares to the existing shareholders at 10, but based on a certain proportion. So let's say if you have 3 shares, not if you have 3 shares, if you have 1,000 shares in an entity. So what the company will say that for every 3 shares, you are given 1 at a price which is lower than the existing market price. That is the statement I was looking for. The issue of shares, yes, to the existing shareholders, but at what price? Lower than the market price, based on a certain proportion. So that is what has been provided here. Even you could have used the statement number 2 to explain, because they say the existing shareholders are to subscribe to a rights issue of 3 new for every 1 held, after making the changes in one above, meaning that they will be given the shares at 4 instead of initially 10. So the shares are to be issued at 11 each. Number 3, the company's major supplier has agreed to convert an amount of 1 million owed to him into fully paid ordinary shares issued at par. This is a supplier who was a supplier, sini ule mtu anatuzia on credit. So he has done what? The company's major suppliers agreed to convert an amount of 1 million owed to him into shares. Instead, they pay 1 million out of the, you know that the creditors' balances under the current liabilities, it was 1820, meaning 1,820,000. So out of 1,820,000, the company has decided that they give that creditor ordinary shares of 1 million. They give the creditors the shares of 1 million. Number 4, the bank requires immediate payment of an overdraft, but has agreed to convert the loan currently payable on demand into a debenture carrying an interest of 10% per annum payable in full in the next 5 years. So the bank requires immediate payment of an overdraft. So we will have to pay the overdraft, and has agreed to convert loan currently payable on demand into a debenture. Then the loan, meaning that it was a short-term loan or what? So it might be a loan of a certain period of years. It was converted to a debenture. It was converted to a debenture carrying an interest of 10% per annum payable in the next 5 years. So they have made it to be more, that is to be a long-term loan. Instead, maybe that loan they were supposed to pay in the next, let's assume 2 years. They have decided to convert that loan to a debenture, which will be payable in the next 5 years. Even in Kenya, when we borrow, sometimes we are not able to pay the loans we have for other countries. So they come up with a plan that instead of paying the loans which are due in the next 2 years, let's have a new plan of paying in the next 10 years. But now remember that the interest will be a bit higher than the previous arrangement. So number 5, the balances in the accumulated losses and the goodwill accounts are to be written off. We write them off. Development expenditure is to be written off. We write off. The remaining assets are to be restated to their fair values as follows. So those assets which were there initially, they will be restated now to these values. So these assets which are here, so you will check the one which have been restated to the values given down here in note 7. So meaning we need to check if there was a positive adjustment or a negative adjustment. Number 8, the amount in the share premium account is to be utilized in the capital reduction scheme. The amount in the share premium account is to be utilized in the capital reduction scheme. So the amount in the share premium, which amount is that? 2,000. This one here, the one which is in the equity and liabilities part. The 2,000 is to be utilized for capital reduction. So capital reduction is what we are doing generally in this organization for us to get that entity out of what? Stress, out of financial distress. So here they need the journal entries, capital reduction account, and a statement of financial position. That is the maximum which can be required in internal reconstruction by any examiner. By any examiner, that is what can be required. Nothing else, nothing else. So we do it from the point of journal entries going down. So I expect total concentration, and you provide figures from your end. So journal entries, putting in mind that debiting and crediting. So journal entries. So what do you record in journal entries? So you do a debit and you do a credit. For every debit you do, it must have a relevant credit, and you must give a narration of the work you have done. You have to give a narration of the work you have done. So the first thing I do is all about, remember that the power value was 10. Now it's being reduced to 4. So there was those shares which were recorded at 10. From the statement of financial position, I assume you have the question, because I will not be displaying it again. So the ordinary share capital is 6,000. So the power value is the one which was 10. Now it's being reduced to 4. So we need to write off the 10. So the shares, the way they were stated at 10. So we record the same shares, the 600, because 6,000 divided by 10, it's 600 shares. So I want to write them off. Then I record now the 2,400 shares. That is the 2,400, the capital, not even the shares. Because now the shares is 600. The value of those shares has been reduced to 4, meaning that our new capital value, our capital, ordinary share capital, will be at 2,400. So I write off 6,000, I record the 2,400, meaning that this is stated at 4. They reduced the price from 10. They reduced the price from 10. So meaning, now here, this is where the double entry comes in. So to write off now the capital account, which was stated at 10. So remember that the balance, when we open an ordinary share capital account, The balance brought down starts on the credit side. So that is true. So in order now to write off, I will debit this account, the 6,000, and the credit what? The capital reduction account. So in order to write off the 6,000, that is the first thing you do. Debit ordinary share capital account, credit the capital reduction account. I said the capital reduction account is the main account which will carry out this process of capital reduction. So meaning here, I will debit ordinary share capital, ordinary share capital account, that is 6,000. I will credit what? The capital reduction account. So 6,000. So here you come and say to write off. So this is a narration to write off the old class, to write off the old class of ordinary shares. Yeah. Now we recorded the 2,400. Now in the normal way, you credit this account, you debit the capital reduction. Now you recorded the 2,400. Now at a price of 4, the power is 4, the reduced price. So you say you debit capital reduction, that is 2,400, which is 600 times 4. You credit ordinary share capital. That is 2,400. So you say to reckon the new class of ordinary shares. So what we have done is just the first statement. What we have done is just number 1. Number 2, let's now record the rights issue. Because you were told that existing shareholders are to subscribe to a rights issue of 3 new shares for every 1 shares held. After making the changes in 1 above, the shares are to be issued at 11 each. Meaning, what is the company receiving once it's giving out shares? Even if what it will receive is not equivalent to the shares it will give out, it's receiving money. Ingawa hiyo pesa yenye na receive, it's not equivalent to the shares. Senye wamefanya nini? Wamepeana. So the additional information number 2, they were saying that the existing ordinary shareholders are to subscribe to a rights issue. So they were subscribing to a rights issue. So that is why I was saying that what will the company receive? Money. So cash book will be debited. So the cash book will be debited, meaning that the company gave out what? Shares. Ordinary share capital. So credit ordinary share capital because the company gave out shares. So, but remember that our price at which the shares are stated now it's 4. But here they said, in that additional information number 2, the shares are to be issued at 11. So under the cash book, I will take 600 times the proportion. The proportion was the proportion at which they are issuing the rights issue, 3 for everyone. 3 for everyone times the 11. So for the ordinary share capital, we see 600 times 3 for everyone times the 4. So here, the amount in excess of the new power value is what we call the amount in excess of the power value is. Sorry?
Premium.
Share premium.
Premium. Now, are you seeing what I'm writing on the board? Or still it's small? Codings.
Yes.
Iko sawa? Is it okay,
Mwalimu.
Codings?
Niko sawa.
I have a question.
Yes.
Where are you getting from the 600?
The 600 is the shares. Remember that which are now the shares we have. It's 600.
Okay.
The capital, our capital was 6,000. The power value was 10. So we reduced, the shares were 600. Even if the price was reduced to 4, so you got 2,400. Even if again you take 2,400 divided by 4, so you get 600. The shares are 600. The shares which the company gave out. The shares which the shareholder subscribed to. So meaning that the company had gave out 600 shares. I think I'm right, that is fine.
Okay.
So this one is on issue of a rights issue. So 600 times 3 times 11, 19, 800. 600 times 3 times 4. 600 times 3 times 4. This is 96. 600 times 3 times 7. This is 12,600. So you debit the cash book, you credit the shares which were issued through the rights issue. While considering the share premium, the share premium is the price above the par value.
Only ordinary share capital is 72.
Or it's 72, not 96.
7,200.
That is correct.
Mm.
Okay. So it balances. If you add this and this, you get 19,800. Yes, so this is 19,800. Remember that the credit and debit is supposed to be the same. So if you add the two, you are supposed to get this. The next entry we are supposed to do. Benson.
Yes, mwalimu.
Umetoka kwa duka?
I'm almost kufika kwa nyumba sasa.
Now you are seeing what we are doing.
Yes, I can see now.
So the next entry was additional information number 3. The company's major supplier has agreed to convert an amount of 1 million owed to him into fully paid ordinary shares. So which entries would I do here? This is something you have been doing even from financial accounting. What they have done is that they have converted creditors' balances to shares. So what would I do to the creditors account and what would I do to the capital account? What would I do? Someone?
I think you should debit credit account and credit.
Yes, because now Because
Debit creditors account.
you debit, if we were to prepare the creditors account, then there was this amount of 1820 outstanding here. Then out of this 1820, now they have converted 1 million to shares. Remember that we have to debit that 1 million to reduce the 1820. So we debit trade payables.
800.
We debit that value, then we credit ordinary share capital.
Same amount.
Yes. So on conversion of creditors balances. On conversion of creditors balances into shares. Aye. The next thing we do is additional information number 4. The bank require immediate payment of a bank overdraft. So bank overdraft, we debit. Or I don't want to rush and tell you what's supposed to be done. A bank overdraft is a liability account. This is just a liability account. When you go and withdraw from a bank more than what you have in your account, any money coming in, it must pay that overdraft. It's like a freezer. When any amount is deposited to your M-Pesa, it's deducted. So meaning that if we were supposed to pay an overdraft, see, we debit that because now the liability account has been reduced because now they say that we pay overdraft. So tukilipa hiyo deni imepungua. So deni ikipungua tunafanya nini to liability, to the relevant liability account? We credit or we debit? We debit. Bank overdraft, I will write in short, OD. So the bank overdraft from the statement of financial position was 1100. So meaning that what am I supposed to credit? What would I credit?
Cash.
Cash. Tulilipa na pesa. We paid using money. So we say on settlement of bank overdraft. Yeah. Then again, in the same sentence number 4, they said, but has agreed to convert the loan currently payable on demand into a debenture carrying an interest of 10% per annum. So a debenture is converted to, not a debenture, a loan is converted to a debenture. What's supposed to be done to the loan? It's like I said, this was a loan which was supposed to be paid for a short period of time. They have decided that instead we pay this loan now, let's convert it to a debenture so that we pay it after 5 years. So what are we supposed to do to the loan? Because the loan from the current from the current liabilities, that is, yes, I can see the bank loan is 4,000. What am I supposed to do to that 4,000?
You laid off.
So by doing what?
Debit the loan account.
So debit the loan. You credit now, it's a debenture, 10% debenture. So it's 4,000. On conversion of the loan into a debenture. Aye. Number 5, the balances in the accumulated losses and the goodwill accounts are to be written off. Number 6, development expenditure is to be written off. So number 5 and 6, I can do them concurrently. So why? Because both of them, note 5 and 6, it involves the writing off of accumulated losses, goodwill, and development expenditure. So how will I write off accumulated losses? So remember that, obvious, if it's internal reconstruction, we have not been retaining gains. We have not been retaining profits in the company. Our retained earnings will be negative. If they don't call it accumulated losses, they give you a retained earnings, which is in brackets. That is what they call accumulated losses, a retained earnings, which is negative. So that is an expense to the entity. I will not perceive it as an equity. I will perceive it as a cost to the entity. So a cost to the entity, to write it off, an expense to be written off, it's debited or credited.
Credited.
So I will credit, debit capital reduction, because there's no another relevant account. I will credit, I will credit the accumulated losses and debit the capital reduction. So for goodwill, is an asset. Assets are debited. To write off, you credit. So you credit the goodwill account, you debit capital reduction. Development expenditure. Looking at my statement of financial position, the development expenditure is considered as an asset. Remember that any preliminary expenses, preliminary, I mean any expense prior to the formation of an entity, they are considered to be assets. That is why you are finding that here, they are considering development expenditure as an asset. It's a prior expense to the formation of a company. So being an asset and they are saying we write off, what am I supposed to do? I credit. So meaning accumulated losses is credited, goodwill is credited to write off, development expenditure is credited. What am I supposed to debit with? I will add those total amounts for the 3 items. I debit with capital reduction. I want to squeeze a bit. Debit. So I have said we debit what? Capital reduction. I credit accumulated losses, goodwill, and what? Development expenditure. So accumulated losses is 2070. Goodwill is 1300. Development expenditure is 750. So add the 3. Give me the figure I debit with. To write off accumulated losses, goodwill, and the development expenditure. So the total of the 3, 2070 plus 1300 for 220.
For 220, yes.
So after that, we go to additional information number 7. Remaining assets are to be adjusted to their fair value as follows. So we want to check if there's a positive or a negative adjustment, which is done to these assets. So the value of land and the building, if you check it in the statement of financial position, is at what value? Is stated at, so land and building, 3160. So it was restated to what? 3320. Is that a positive restatement or a negative? Positive. By what value? By which value? So the difference, 3160 to 3320. So the positive restatement by what? 320 minus 160 is 160. So meaning there's a positive restatement. So positive restatement, I will debit the asset, because if I was to open the asset account, if I was to open the asset account this way, here I have 160, then by the end is 3320, meaning that the increase of 160 could have been on the debit side, the increase from 3160 to 3320. So meaning I debit land and building, the 160. I credit capital reduction. $160. On positive fair value adjustment. And the others, I think it was a negative fair value adjustment, of which I can check if all of them I can check if all of them are on a positive or a negative fair value adjustment, the others which are remaining. So like plant and machinery, from the statement, it was stated at what? 4,040 shillings. Yeah, and note 7, 1,000. So the reduction by 30, 40. Then the other set, which is in note 7, inventories 1,500. Above there it was, so it was 19, then it was restated to 15. You see, even that one is a negative adjustment. Receivables, we have 17 down here on the adjustment, the same with the statement of financial position. So meaning, I will just record the two, because for the receivables, there is no adjustment. So we have the plant and machinery. And we have, so to avoid this way I'm doing, so I will start with capital reduction so that I debit this. Then I credit plant and machinery because they are just a negative adjustment. It's not a positive. So plant and machinery, it was from 4,440 to 1,000. So meaning that it reduced by 3,040 shillings. Then we have inventories. Inventory, it was from 1,900 to 15. So that is 400. So for receivables, it was 1,700. So there's no difference in terms of adjustment. So the total of the two, we get 3,440. So on negative fair value adjustment, on the negative fair value adjustment. All right, so we are done with note 7. Note 8, the amount in the share premium account is the one which was done what? Utilized generally for the reconstruction. So the amount was in the share premium. It's under the equity, 2,000. So it has been generally used in the reconstruction of the entity. So meaning that a share premium, it has a credit balance. So that amount, if it has been utilized for the reconstruction, see, I write off that amount from our equity. So to write off, I will do what? I will debit share premium, the 2,000. I credit what? Capital reduction, 2,000. So I will give a narration and say, being amount utilized where? In capital reduction. Being amount utilized in capital reduction. So once we are done with the channel entries, we always say that kazi imeisha. Hakuna kitu imebaki hapa. Ukimalizananga na hizi channel entries.
Excuse me.
Yes, Collins.
What are you supposed to include in the journal entry? Are you supposed to look at all adjustments and
So the next thing I said here now we are supposed to do, even if you are not told to do it, is the capital reduction account. But in this question, you are told to do the capital reduction account. You are told to do the capital reduction account. Then I said, after you do the capital reduction account, you do which account?
Ordinary shares.
Yes, you do the ordinary share capital account. So when I'm preparing the ordinary share capital account, my balance brought down is on the credit side. From the statement of financial position, it was 6,000. So now I want to see if you have been taking notes. What I want to use here is what we have done from the journal entries. Do you remember our first journal entry? What was on the debit side and what was on the credit side?
The capital reduction was on debit side, 2,400.
What was on the credit side?
Capital reduction.
Then ordinary share capital was on the debit side. Yeah, so what was on the debit side? But this one cannot be seen on the other side. If I was having someone to zoom, I could have zoomed my phone. So what was on the debit side is the ordinary share capital. And what's on the credit side is the capital reduction. So the way they appear in that journal entries is the way you record them here. So yes, the ordinary share capital of 6,000 is on the debit side. I will record 6,000. But with what is on the credit side? Capital reduction. The double entry rule. The capital reduction is on the credit side, 6,000. But with what is on the debit side, ordinary share capital. Let's move to the second journal entry. So the second journal entry, capital reduction was on the debit side,
Debit
2,400.
side.
2,400.
Yes.
So which information is on the credit side?
The ordinary shares.
Ordinary share capital. Then the ordinary share capital is on this credit side, which is 2,400. Which is the information which is on the debit side? Capital reduction. So you can see here what we have done. We have just cancelled the old class. We have just cancelled the old class of ordinary shares. We have cancelled that. Then we have recorded a new class at 2400. Journal entry number 3. Cash book was on the debit side. Am I preparing cash book anywhere? No. What is on the credit side
No.
is? What's on the credit side is the ordinary share capital of 7,200.
Yes.
But what would I record here? Cash book. The one which is on the debit side. There's no share premium. I'm preparing there. We continue with the next journal entry. The next journal entry was all about trade payables and ordinary share capital. So ordinary share capital was on the credit side 1,000. So meaning what is on the credit, what is on the debit side is the payable.
Yes.
So I have a question. What happens to this share premium? Is it not supposed to be accounted in the ordinary share capital account?
But in the ordinary share capital, it will be accounted when maybe I do the statements, but not at this account. There is no way they are affecting this account.
So how do we know the entries that affect the capital reduction account?
It's according
Like,
to what
is
we have
there a
done.
criteria? Yeah.
It's according to what you have done from the journal entries, because I'm looking where do I have the capital reduction? Where do we have, where can I see the ordinary share capital? According to the journal entries I've done.
Okay.
It's according to the journal entries you have done. Where can I see the capital reduction? Where can I see the capital reduction? That is what I'm using. Like now, after the 1,000, the next journal entry, can you see ordinary share capital or capital reduction? Under the bank overdraft and cash book, there's nothing like ordinary capital reduction or ordinary share capital. The same way with the next journal entry. I think you have these notes. So let's go to this point. In this one, there's capital reduction. This one will express more what I've been doing. So you see this capital reduction here.
Yes.
But this is for 220 on the debit side, but it's represented by what and what?
Goodwill, development expenditure, and accumulated losses.
Yes, so that is what you debit with. So meaning that when I come to this account, I will say accumulated losses, 2070, goodwill,
1,300,
on the development,
750.
750. So they are adding up to 4120.
20.
So when I come to this account, I can see my capital reduction is of 160.
60.
So I will record here 160. But when I say capital reduction,
No, land and building.
so I will say land and building. I think now you have understood what we have been doing. So we were under, before our machine went off, we were under the point of this run and building. So we have recorded that. So the next thing is we can see capital reduction.
Is debit side.
Debit side. So meaning that instead
It's
of me,
affected by plant and machinery inventories.
But so see, those are assets, so I can say assets instead of a lot of information.
Yes.
okay?
Yes.
34, 40.
40.
But you can decide to record separately, plant and machinery and the inventory. Then
The
we
last
have
one is
the last one. Yeah, we have a capital reduction 2,000
capital reduction
on the credit
being
side.
affected by share premium.
So that is what I will credit with. So the 2,000, yes, it's on the credit side, but I will record with share premium.
Share premium.
So once you balance this one, if the balancing figure is on the debit side, it's a capital reserve. If it's on the credit side, it's a goodwill. Then here we have balance carried down. So kazi kwenu.
And 400 plus 1300 plus 750, 2070, 30, 40, 400, 99, 60.
So this one is 10.
First one is
the balance carried down. The first one, the balancing figure is? I need the
1800. It is going to be a goodwill.
So
1800.
the totals,
1960, 9960.
9960.
Yes.
Kila mtu anapata hivyo.
Yes.
Oh, sawa. So I think I can clear the board.
Some minutes.
I mean, I think that is okay.
All right. Okay.
So we do the last thing, that is the last part of the question. So the examiner was in need of, now we have reconstructed the entity. Now we present a reconstructed statement of financial position. So this one was a Fanakawa. So Fanakawa. Remittent. So opening statement of financial position. So aside, because now it's as at the start of the new year. So the new year is starting on. So you know that our financial year is ending on the 1st December 2017. So 1st January 2018.
18.
The company will be reconstruction. That is a reconstructing. So the statement will be operating at a positive position. So non-current assets. So land and building, now they were restated to what? This one was restated to, according to note 7.
3320.
So this one was restated now to 3320. Then we have plant and
Plant
machinery.
and machinery, 1000.
Then intangible assets, remember that the intangible assets we have there, they were written off. Goodwill and development expenditure was written off. The only goodwill I will record here is what
From
we
the
have.
capital reduction, 1800.
This one. So current assets. So for the current assets, inventory was restated to what?
1,500.
Inventories 1,500. They never purchased any stock. We earned. Trade receivables remained to be at 1,700. And cash. They received something here. When they issued shares through rights issue, the cash book, the debit side was at what amount?
Was
600.
19.
We said 600 times 3/1 times 11.
Yes.
What do we have? It was
19,800.
800.
19.
800.
800.
Then they paid something. What did they pay? Overdraft. They paid an overdraft of.
1,100.
So the overdraft is 1,100. So the balance of cash remaining with them is
This 19,800 minus 11. 18,700.
18,700.
so total assets. Oh. Equity and liabilities. Ordinary share capital. And try muting your mic. Remember, this session is recorded. Also, a lot of background noise will be it will force me again to edit. So even if you are answering something, mute after that. So ordinary share capital. So the balance, give me this figure. It was 10 something, 10, 600. The account we did, eh?
Yes, 10,600.
Share premium. Which share premium would I record here?
The one.
The one which was in excess of the 11. But the 7 is what? The one you asked
3/1
600
times
times
7
3/1 times 7.
and 7. It's 12,600.
12,600.
Yeah. For now, we don't have any retained earnings because we have written off the losses. Now we are at a positive position. We are at a positive position. So current liabilities. So under the current liabilities, we have the trade payables. So of which under the trade payables, it was the value was 1820. But out of this, 1 million was done what? Remember, our question is in thousands. Our statement is in thousands, that is. So out of these 1820 of the creditors, the company decided to convert 1 million to shares. So this one is here.
Shares, ordinary shares.
All right. So the balance is 820.
Minus
For the
1,000.
bank overdraft was paid. No, not was paid. It was the one which was utilized for reconstruction. We wrote off that one. Bank loan was converted to a debenture, meaning that we have not recorded that as an non-current liability. So that is what I could have recorded as non-current liability.
4,000.
So sorry?
On trade payables,
Uh-huh.
I'm tracing where we. Oh, okay, I get almost 3.
Yeah, so let me record first. I was first to record the debentures. Remember that there was a loan which was converted to a debenture. There's an uncurrent liability. So the bank loan, see, they said somewhere in note 4 that the loan was converted into a 10% debenture payable in the next 5 years. So we have that loan was converted into a debenture. The loan was at 4,000. Then current liabilities now we record. Current liabilities we record the trade payables. So trade payables today it was 1820, meaning that in note 3, the supplier agreed to convert 1 million hold to him into fully paid ordinary shares. So out of this, 1,000 they were given as shares.
Yes.
So meaning that the creditors balances remaining is 820. For the others, we are done. So total equity and liabilities.
$28,020, the first one.
28,020.
Yes.
The second one here.
The same.
Same.
So that is how you are supposed to do reconstruction. This question, it does everything. It does every concept. It does every requirement which you can be testing. Even if yes, we'll do 2 more. There's a question for 2021 or 2020 something. And that one for 2014. Before we move to external. External, I will start with the receipting question. Then I add another one. So I think we can stop at this point if you don't have any question. Don't want to do another question. We cannot do another question.
Excuse me.
Mhm.
I have a question, but it's on impairment of assets, clarification more so.
Mhm.
On like the assignment you gave us of November 2019, where we were supposed to use the depreciated replacement cost approach.
Mhm.
And we were told the asset had dropped to, the usage of the software had dropped to 15% or whatever. So
It dropped it to
15%, the usage had dropped to 15%.
to or by.
It's originally anticipated dropped to 15%.
Mhm.
So my question was, tukitafutia recoverable amount tutumia value in use ama tutachukua tu the cost minus depreciation venye tulifanya ya the depreciated approach
Wamekupea
ndio
value
tupate the
news.
impairment loss.
Wamekupatia value news.
Hapana, but sisi tunaweza tafutia juu tuko na hiyo percentage ama.
So once you use the replacement cost was a new one. A new one can be bought at. They can buy a new one at
150 million.
150 million. So accumulated depreciation. So you take 150 divided by the years times the years it has been depreciated.
Yeah.
You minus. So the figure you get here, you multiply with 15%. That is your recoverable amount.
Oh, okay.
If it's 2, but if it's by, you use 75. You use 85.
Okay.
So here you check. If it's 2, you use 15. If it's by 15, it means that you have to use 85.
What if we didn't have the percentage?
So I could have just used this direct.
Okay. So, thank you.
As my recoverable amount.
Okay. One last question.
Mhm.
Kwa assignment tulipatia hii insurance.
Mm.
Hata kama ujambo in your account, you have to come up in your account, right?
No. In that question, I know that
Because
I knew that would be the challenge. That is why I gave it as an assignment. There is no information to use in the determination of revenue account. So your revenue account would be like the income statement. So you are supposed to understand which are incomes, which are expenses, which are items to be added, which are to be subtracted. And that is how you develop an income statement. There's nothing like doing a revenue account there.
okay.
Yeah,
Please
so
share
the so that is the case. There is no revenue account to be done there.
okay, thank you.
Any other question? Another contribution? Anyway, that's all for today.
I'll give you a call.
At this
Mwalimu.
time, I don't take any call.
I'll give you a call. We talk.
Maybe tomorrow.
Okay, sir. Or else we meet physically tomorrow.
Yes.
Sawa, sawa.
Yeah.
Okay.